So the housing market crash isn't coming, it's already here. So while the media is still trying to sell you on the idea of a soft landing, the hard numbers are telling a very different story. And if you've been watching the housing market long enough, like we have for over 2 decades, well, the patterns are disturbingly familiar. See, in 2006, we saw the first cracks long before the headlines caught up. This time, the crash is happening in slow motion, and most people don't even realize it's underway. But the signs, I'm afraid, are crystal clear, and they're happening right now in cities and towns across America. So today, I'm going to walk you through 5 massive red flags that prove the housing market has already entered crash mode. Now, these aren't predictions, these are the hard facts that are unfolding in real time. And if you own a home, or you're looking to buy, or you're thinking about investing in real estate, well, you need to pay attention. So, the first unmistakable sign is the surge in housing inventory. Now, according to Realtor.com, national active listings jumped 28.9% year over year as of April 2025. In some states, like California, the jump is even more dramatic, up 36%. Now, more inventory sounds like a good thing for buyers, right? More choices, better deals, not necessarily. See, when inventory surges this quickly, it usually means sellers are flooding the market faster than buyers can keep up. A case of classic oversupply. Now, properties that once sold in 2 weeks, well, they're now sitting on the market for a month or more. In high priced areas, inventory is piling up like we haven't seen since 2008. Now, here's where it gets more telling. This spike isn't fueled by builders suddenly flooding the market with new construction. It's mostly existing homeowners deciding to sell while they still can. Now, that get out before it gets worse mindset, well, it often signals the early stages of a downturn. We're also seeing a rise in stale listings. That's homes sitting from 60, 90, and even 120 days. Now, in real estate, time is the enemy of price. The longer it sits, the more leverage buyers have to negotiate down. What about the second sign? Well, it's price cuts, and they're spreading fast. Now, in May 2025, 19% of all home listings had price reductions, and that's the highest percentage for any May since at least 2016. That's nearly 1 in 5 homes lowering the asking price, and it's been happening for 6 consecutive months. So we're talking major markets like Denver, Phoenix, and Austin. Well, they're seeing over 30% of all listings slashed. And remember, these were some of the hottest pandemic boom towns. So a $500,000 listing dropping to $450,000 in just months, well, that's a 10% loss. And in many cases, they're still not selling. Sellers are chasing the market down, and that almost always accelerates price declines. Now, it's not just luxury homes either. We're seeing price cuts across starter homes, mid tier, and even investor flips. The South and West, where prices skyrocketed during COVID, were there leading the way downwards. On to the third warning sign, and it's the explosion in seller concessions. Now, Redfin reports that in Q1 of 2025, 45% of home sales, including concessions, up from 39% a year earlier. And Seattle is the standout. A staggering 71% of sellers are now paying buyers' closing costs, buying down mortgage rates, or even offering cash credits. Now, here's why this matters. Concessions are essentially hidden price cuts. A $10,000 closing cost credit means the seller nets $10,000 less, even if the sales price looks unchanged on paper. Now, in a strong market, buyers compete and they waive concessions, but in a weakening market, sellers offer them up front just to get someone to make an offer. Historically, high concession rates like this are an early stage distress signal. They tell you sellers are losing negotiating power fast. So, my financial warriors, Just before we dive deeper, it's imperative you hit that like button and subscribe so that you get notified the minute we produce another game-changing video that helps your financial situation. I promise it will help and you will appreciate it. So buckle up and let's take an even deeper plunge. So the fourth sign is the uptick in foreclosures and mortgage delinquencies. Now, ATTOM data reports that 94,000 foreclosure filings in Q1 of 2025 is up 6% from the previous quarter. Now, foreclosure stats, the first step in the process, rose 14%. So states like Delaware, Florida, and Illinois, well, they're at the top of the list for foreclosure rates. Even more concerning is that FHA and VA loan delinquencies are rising faster than conventional loans. Now, these products are heavily used by first-time buyers and veterans, many of whom bought at peak prices with low down payments. Now, as equity evaporates, some are finding themselves underwater, owing more than their home is worth. Now, we saw this exact pattern in 2007. Starts slow, then it picks up speed. So by the time the headlines scream foreclosure crisis, the smart money has already adjusted their positions. So on to the fifth and final most dangerous sign. Housing affordability has fallen off a cliff. Freddie Mac's 30-year fixed mortgage rate is sitting at 6.8% and is expected to stay above 6% through 2026. Now, according to the National Association of Home Builders, affordability is down nearly 30% since late 2021, putting us back at levels not seen since the late 1980s. Buyers are being priced out, even with price cuts, because the cost of financing remains painfully high. The lock-in effect is also freezing parts of the market. Over 80% of homeowners have mortgage rates 1% or more below current rates, and many have sub 3% rates. They can't afford to trade up or downsize because their payment would double or triple. That's creating imbalances, and that's massive inventory gluts in some areas while other segments remain tight. So now, here's what all this means for you. If you're selling, the clock is ticking. Each month brings more competition and bigger price cuts. If you're buying, well, patience will likely pay off. This shift is favoring buyers obviously more with each quarter. For investors, the days of buying anything and watching it appreciate, well, sadly, those days are over. You need strong cash flow numbers and markets with real economic growth, not just pandemic hype. Now, this isn't the 2008 collapse in terms of reckless lending, but it is a structural crisis driven by affordability, rising distress, and a shift in buyer psychology. So the 5 signs: surging inventory, rising price cuts, exploding concessions, climbing foreclosures, and collapsing affordability, well, the bad news is they're already here. So the real question isn't whether we're in a housing market crash, it's how deep this one actually goes and who will be ready to take advantage when the dust settles. Now, as always, I'll keep you posted on the housing market, and in the meantime, have a great day, and I'll see you guys on the next one. Take care.